This Friday morning, we've woken up to a very ugly set of global cues. China, Ukraine, and comments from the German Chancellor are having impact on all major asset classes. Money has moved out of equities. Safe haven trade is back as US bond yields have appreciated, and gold prices are also sitting at a fresh 4-week high. So how should one invest in this kind of an environment where globally things surely are not looking all that appealing? Andrew Freris, independent consultant, joins us live from Hong Kong. Andrew, good morning. Thank you for joining us. Andrew, unfortunately, this Friday morning, we've not woken up to fabulous set of global cues. China is a big problem, and concerns in Ukraine are mounting again.
Well, let's take this one step at a time. Let's do Ukraine, because that's the easiest one. This is a political issue. It's not an economic issue. It has economic repercussions, to the extent that people are concerned that, for example, let's say if Ukraine was to default, that would have been bad news for other emerging markets. But Ukraine itself, on its own, it's of no economic significance whatsoever, except as far as political significance to Russia and to the European Union. So we have to keep that in perspective as opposed to let it flood anything else. China. There are no news in China. We know it has been slowing down. It has been slowing down for nearly 6 to 8 years now. All we have seen is a further mild acceleration, well, mild sort of, in a number of key indicators. So I'm afraid I do take that into account, absolutely. Okay, but it is of no surprise whatsoever. The Chinese economy has been slowing down for a long time, and it will continue to do so. Now, presumably until either the authorities panic and they reverse some of the tightening policies they had in place, or, which would be much, much worse, they reverse some of the economic reforms that will undoubtedly cause the economy to slow further. It will be of crucial importance in the next 12 to 24 months going forward. I hope to God that the Chinese authorities don't panic at this stage, because they're really playing with the long-term prospect of China. Unfortunately, the Chinese equity markets will continue to be the worst performing markets, possibly, as they have been in the last 5 years. As I keep saying, no news here. Okay, whilst China has had quite strong economic growth, now it has been decelerating, and this, of course, doesn't reflect at all on the equity side. So, yes, I'm afraid this is bad news, but I'm afraid it is no new bad news, if you see what I mean.
Andrew, what's the sense then when it comes to asset classes? Is it a given that dollar and precious commodities as well as crude are going to become more dearer because people are going to run out of equities and, run to safe havens?
I will have my grave doubts about that because, for example, not all asset classes are performing poorly. The yen and the euro have been exceptionally strong. And look at that. Aussie dollar moved very quickly yesterday, despite the fact of the poor China news. So, let's not put China absolutely in the center stage, and this is at all that matters. The United States has had quite a series of strong data, and guess what? In next week's meeting of the Fed, we're going to get the usual good, bad news. In other words, they will continue with tapering. They will cut another 10 billion. I have no doubt about that, because we had very strong ISM news, okay, Institute of Supply Management. We have had very strong, or rather good, solid news out of employment, although unemployment slipped up a little bit. So I'm afraid, okay, the macroeconomic news out of the United States are staying quite strong. So, it's not a matter of simply leaving equities. I'm still bullish medium to long term on equities. I'm still staying with equities in the United States, in Europe, and less so excited about Japan, because the process of economic reform has seemed to slow down. So on the basis of a set of unexpectedly expected, if you pardon my English, poor news out of China, I would not simply desert equity straight away. The Chinese equity market has been a poor performer for nearly 4 to 5 years now. No news there.
Andrew, for the moment, everyone is assuming that US economy will make a comeback, and the comeback will only pick up some momentum in the second half of 2014. But if I look at the Chinese export data, which often is an indirect indicator of what global economy is doing and where global growth is headed, the Chinese export data for the month of Feb was not that impressive.
Well, again, if we are talking about United States, let me give you a very simple number. Exports from the United States to China is less than half a percentage point of United States GDP. It's of no importance. So whether United States exports to China, it will have zilch impact on its GDP growth. It's as simple as that. You know, the notion that China drives the global economy, I'm afraid, is statistical nonsense. Okay, China is of huge importance when it comes to commodities. So it does have an impact on Brazil, on Argentina, and on Australia. But I'm afraid Germany, United States are not major exporters of iron ore, of coal, of major commodities, agricultural commodities. So the obsession of China as a driver of the global economy, I'm afraid, backs up the wrong tree. It is important for some countries and for some commodities, but not for everything else.
All right, Andrew, appreciate your time, and thank you for joining us. That was Andrew Freris, independent consultant, and he joined us live from Hong Kong.